Make sure you don't say anything that you don't want heard by the entire classes. So, all right. Let's see. We did, any other questions coming from 9? I know we just talked about a few of them with the 414H. You know, making sure that on that 414H, treat it traditional on the federal and like a Roth on the state. So tax-free on the federal. And that means on the W-2, we might have to check that box. Remember the box I showed you to check on the W-2 that allows you to uncalculate the sections.
14?
What's that?
I'm 14.
Well, it's a little bit different. Let me kind of show you here. Let me do something.
Randall had one.
Yeah, let me show you on the. Let me get the Boyds here. I don't think I'm okay. So if I have the Boyds, and I have a W-2 here for the Timothy Boyd. Okay. And with the Boyds, he has if he has income here of $50,000 and withholding of 5. Okay. And over here, if you, in box 12, if you put D, whoops, D, and make sure it's capital. So D, and you have $3,000, okay? If you look at boxes 1, 3, and 5, it made the adjustment for you, okay? Because box 12 allows to calculate. So it made it 50,000 taxable and 53,000 as far as total wages. So, because those are pre-tax dollars, okay? Now, if I get rid of that in box 12, and this is a teacher, and they have, you can see where it's got the 414H SUB, and I put the 3,000 in there, okay? It doesn't do anything to boxes 1, 3, and 5. But like I said, you treat it like a traditional IRA on the outside. All right?
So now that will change that on the state automatically, because then it'll be taxed.
It goes to the state for us, okay? So we see that $3,000 there in the additions on line 21, okay? But on the W-2, it has to be treated like a traditional. If I go in here and I know that this has to be $3,000 great, and I try to type it in, what do I get? Yeah. So that's where if you have a 414H, you got to go up to this box right here that says take calculations off, okay? On your software, it'll probably change it from a yellow number to a green number, okay? And once I do that, now I can go in and make this 53,000, and I will also have to make the adjustments on 4 and 6 because it won't calculate. Because 3, 4, 5, and 6 typically are pre-calculated based on what you put in 1, okay? Or you put in 12. But when I have a 414H, because it is tax-free on the way in on the federal, all right, I have to make that adjustment, and then I would also have to make, and this might be that this ends up being 3,300 or something. This might be 825 or whatever. So I have to correct 3, 4, 5, and 6 when I have a 414H SUB. See how I did that?
Right.
Because what happens is, and I apologize, I don't have it the way you guys may have it, the colors. But typically these would be yellow numbers, and as soon as I put that number in, it calculates these, okay? But because of that 414H SUB, I have to check that box, takes all these calculations off, all right? Then I have to enter these numbers off the W-2 manually, all 4 boxes, not just change these 2, okay?
Basically, you're only doing that for teachers?
That's where you see the 414H SUB most often.
Not for state workers?
Not unless they're participating in the 414H. Some state workers will.
And it will be on that form that you do, they give you, is saying that they.
The W-2?
3,000.
The W-2?
And it's always
Yes.
on the W-2?
Yep. But like I said, you got to make sure. No, it's not an additional form. It'll always be on there, but it's in 14. Okay? So it's not like 12 that goes somewhere. 14 never goes anywhere. We have to manually carry it. It's like when it says United Way for charitable contributions, it doesn't automatically go to our Schedule A. We have to physically put it on the Schedule A. So 14 is a box that always has the case where you know, that we have to carry things forward. However, this code 414H SUB will carry to the state, okay? But it does not change things up here for us on the W-2, so we have to manually do it, okay?
And that means we have to figure that out. Too.
Yeah, and the other thing is too, is if you get one that just says 414H, make sure you put SUB after it. Because if you don't do that, it won't carry to the state the right way.
It automatically came up when you put the voids in there.
It's a default. That we make it a default because it's so important. We used to see so many mistakes. You know, we can set a lot of defaults on the software for the prepares. So we automatically put that in. It doesn't hurt anything if it's there and you take it
As long
out.
as you don't put a figure there.
Exactly.
So that's why, that was my big question, because when I was going over, I was like, wait, I don't remember putting that in there. Because it was a default. It's red over here as 0.
Yeah.
That's why I never put a figure in there.
Yeah.
So I should delete that 414 if we were doing someone else's tax return?
If it's not on their W-2, yes. And always make sure too, sometimes you delete it and you'll put what in here? New York State Disability Insurance, 3120. Make sure you uncheck the 8880 box. Otherwise, you're going to get a credit for $31 on the retirement if their income's low.
So if on the federal, you don't do it, I mean, you treat it like an IRA.
A traditional, yes. So it does two things. It lowers taxable income and it may qualify for the saver's credit.
So, okay, this is the W-2 on the federal. So
Yep.
you have to adjust, if it's there, you have to adjust the W-2.
Yeah, you have to almost manually enter every box in the W-2.
And you get those figures from, you would just add 14 to that one for the Social Security, not wages.
Yes.
And then you would have to manually look up for the Social Security on 53,000 versus
No,
50.
the W-2 will have it on because they calculate on the W-2.
would,
But
they
like I said,
calculated it.
if you go in and just change these two won't change because you've taken the calculations off.
Now I'm getting
So 3, 4, 5, and 6, you got to manually transfer them from the W-2 to the tax software. It's not like when you have a normal W-2 where it's calculating 40.
Got it.
Is that making sense, Jim?
I'm just, makes sense, so whenever there's a report on that, I have to adjust the W-2.
Manually, 1 through 6 have to be put in. Usually you can just put 1 in and it does all the calculation for you.
Right.
Right.
And you do that, whoops,
And then, but then going back to the 1040,
this one.
will that pull the 3,000? Or do you still got to just manually put it in as a? It's already out because it's.
yeah, it's already there.
already-
Yeah.
it's
The only
already
place it
out of
would
the
carry
way.
to on the 1040 is if it qualified for the saver's credit. Yeah, you don't have to do anything on 15 or 16. It's not like a distribution. And you can't do anything with, when we talk about adjustments to income, we'll talk about contributions to an IRA. It's just that it's handled so different between the federal and the state that you got to do a lot of manipulation of the W-2. All right?
That makes sense. Couldn't figure out why I had that.
And then for this year, you said 2. It's basically federal, if you have the standard deduction, chances are you still need to keep track and you may be better off itemizing
On the state.
on a state.
Yeah.
So either,
Yeah, because the state, I think they're going to have a, you know, every indication is they're going to have a much different set of rules where things that have maybe been eliminated on the federal will be, you know, used again on the state. And especially the section that we're going to talk about today, the second half of the itemized. Okay. All right. Let's see here. So problems that we did from chapter 10. Would you like the answers?
No,
The workbook problems. Yep.
yeah. See if I-
If you're close.
Yeah.
All right. Let's see. We did we do any problems out of 10?
I thought we did one. I can't
Oh, we did Garland,
Maryland.
right?
Right, because United Way did not carry over on the W-2
Okay.
for the itemized.
Is that who we did? Oops.
So I think we did that one.
Let's see who we did here. Yeah, we did Jason Garland, okay? And Jason had owed a federal balance of $414 and had a state refund of $145. Okay. The Storm family, they had a federal refund of $34.25 and a state refund of $16.01. All right. And then 10-3, we had the Hodge family. Had a federal refund of $66.78. Strange noises coming from Jim over
I
there.
haven't looked.
Okay. And a state refund for the Hodges of $17.39. And then we had the Stouts. We had a federal refund of $329. That's better, Jim.
Yeah.
All right, and a state refund of $776.
Now I gotcha.
Okay,
The other two are off.
off by a little bit?
Yeah.
I mean, a little bit as in a little bit, or as in,
The Hodges, I got fed, you said 66.70, yeah, I had 66.26.
okay, so we're in chapter 10. Okay, we did Garland. Okay, and for the storms, let's see here. Okay, did you remember to get that $1,100 doctor copays off the bullet points?
I was off only by dollars. On Hodges.
Okay.
Let's see. Okay, so the bullet points,
The only thing really on the bullet point that you had to make sure you pulled out was there was that $1,100. Okay,
$1,100.
yep. And then what did you do with the fact that last year they owed
That was my question.
the 520?
520 on Hodges?
The first bullet point on storm?
Oh, we're Storm I was
Which
fine.
one? No, I'm.
On storm?
We're
Did,
on Hodges over here.
Okay.
Oh, yeah, we're on Hodges.
storm you got?
Storm I was fine.
Okay.
How about
And you got that
Okay,
they,
or do you have a question?
did you get the 520 that they paid to the state?
On Storm?
Yep.
I did because mine was 34.20. Storm, I was on target with 1601 and 3425.
Okay.
And they owed an additional 520 on the state.
So let's take a look at,
I'm sure where to put it now.
all right, got that one up,
Did
Jim?
research it.
Let's take a quick peek.
Storm? Okay.
Yeah, during the
All right,
storms
let's
up.
go back to Storm.
All right, so let's go to your A detail, your Schedule A detail first. Yep, you got the copay, good, okay.
Okay, that's what I was looking for.
Yeah, you got that one, okay. The other one is, and this one's kind of sneaks up because it's tax paid, that 520. And what you did on that one is if you go up to 1040, page 2. Okay, now scroll down and keep going, okay. All right, so we have on line 65, okay, and it kind of hides there. All right, so go over here and hit F9.
On which one, 65?
Yep, hit F9. Okay, see where that federal tax paid, FS tax paid, yep, open that guy.
Mine says earned income,
65,
65.
okay. Now scroll down. All right. And see this line right here? State and local previous years paid in 17. So put the 520 in there. So now we're getting closer.
Yeah.
Okay, all right.
Where did you put
How'd
the
get
5, I put the 520 over
Yep,
here.
perfect.
isn't it?
Yep,
Okay.
perfect. Yeah, we really haven't caught that because of taxes paid. So, I apologize that we didn't have that one, so.
Sorry, I missed that.
All right, so we have that, okay? And let's see.
But it doesn't come up on that.
What's that?
But when I check my 1040 page 2 for that page now, even though I entered it.
But where does that go to?
It has to go to income.
Well, no, it doesn't go as a straight tax paid. It's not like an estimated tax payment. It goes on your Schedule A. It's added to your state taxes paid.
But that would be a deduction. On
Well,
Schedule A.
It would be. So it becomes part of your Schedule A. If you look,
Yeah, because I was trying to find where 520 went, but I know it's in
so
there.
go to your Schedule A. It's added into that box.
With that.
Yep. So it's in there. Okay. Because if you look at their state
Oh, because
withholding,
I owed it. No, I'm fine.
Yeah,
That's right.
because you
I
owed it.
remembered. I
Yep.
didn't receive it. I owed it.
Yep. and it wasn't an estimated payment, so it's
Correct, so-
not
So
But
it's
it-
now in there.
Do you think it
exactly.
would show both? Do you think it would divide that up better?
Yeah.
So that you can see where that,
Yeah, so
520
take this out of there. So that 520 doesn't go there.
that's right. I remember now.
Yep, so take,
So,
yep, we're gonna take it out of there, okay? Yep. There you go. You can put the description over there if you want to.
Yeah.
Okay,
That's a flaw in the program. It should show where it is, so it divides it, so that when you go to see, you see that it did carry over.
well, you should, but
So I
you have to,
had to add it.
you have to know that's part of your state taxes.
Right.
Okay, so go to schedule, or go to 1040 page 1. Go to your 1040 page 1. All right, so let's go through and see what we got here, okay? What do you have on line 7, Mary Ann?
I have 55,612.
Okay, so we have extra income. So we have extra income. We have 58. And you had how much?
55,612.
Okay, so check your W-2s. 30, oops, there we go. Yep. All right. Yep, so put that in as 36,970. Or 971. Yep. All right, now look at your answers. Perfect. Yep. Yeah, that's right. Fat fingers. That's what happens when you drink too much caffeine. You get
Are
fat
we done with
fingers.
that one?
Yep.
Yeah.
Now we can go to the Hodges, right?
Now we can go to Hodges.
Typo.
Typo.
I go on
So,
Typo.
Hodges, I'm only off by a few dollars.
Okay,
And
so
there was a
So was
question
that-
mark.
you know, I had the 520 and that other thing. It's still,
you had it, but you need to know to put it on that federal state tax
as
paid.
far as this goes, the 3,000 was really my error. Because I still
Yes.
had 5.
Yes.
Didn't change it.
Yeah, the 3,000 in
I
income.
was right church on cue. Okay.
Yeah, exactly, exactly. So you had it on the itemized, but you should put it on that. And again, it's one of those little nuances, so. All right, so Hodges.
My question was, the itemized,
Mhm.
fine, they received a $900 New York State refund, and then included a $330 Empire Child credit.
So what do we do with that?
That's what I wasn't too sure with. I'm only
Okay.
$2 off, so.
Jim, what did you do with that for the Hodges? Their first bullet point says that,
So I put down just the 900 for the New York State on the state tax refund worksheet. I had put it under number 1, the whole 900.
okay. What did it give them as a refund taxable?
A refund taxable?
So you can't use the worksheet because you have no history.
Well, that's what my problem was. I'm thinking, I don't know what the
Okay.
2016 return stuff is.
Yeah, so you don't have any history, but what do we do with that Empire Child tax credit from the state refund? We subtract it.
You subtract it from the 900?
So they only have 670 that they report as taxable refund.
Okay, that's under state tax refund.
Yeah, online, yep.
So instead of.
So it'd be 570 then.
Yes. No, yes, 570. Yep, so yeah, don't do the worksheet because the worksheet doesn't work on this.
So
Just
I
hit
have to
remove
remove
form
that.
on that.
Okay,
So
Oh,
go,
just,
yeah, get rid of that.
so then
Okay, now go back to 1040, page 1. Okay, and scroll down. Okay, and see that you got 900 in there where the gray box is on line 10.
I don't have any.
Okay.
No,
I can just manually put that
Yep.
in now, and I would put in the 570 though.
570.
It won't let me.
Hit F8. It's the only time you get to use that button. Okay, so 6678, now you're dead on. Okay,
And it's 6671, and
6678.
I still have 6670 and 1732 instead of 39.
Okay. All right, so.
So that didn't really change my, and it's in gray. It's only.
Get it on? No, it's fine. Yep, it's there. Okay. All right, let's go to, on that one, let's see, what did you deduct off of there?
Maybe I didn't. Maybe I should.
Okay, Jim, go to your, go to your Schedule A. Let's compare to what Mary Ann has. All right.
Schedule A detail.
You want detail?
Yep, nope, just the first Schedule A. Okay, what do you have on line 4, Jim?
Line 4, 4104.
I have 4072.
Okay, so that's where we're missing something now. Go to your detail. Okay. All right, so we had the mileage. Pays and everything, so you added
But
up
I
all that.
took off the 240. I didn't
Yeah.
add that in. I did the braces separate.
So 976, and so you're missing $70. So
This is right. I put in the braces separate, and then the rest of the miscellaneous medical together, just to show the why it was so much.
we got $70 missing somewhere.
Maybe
Did
I
you get that in there for the, looks like the eye exam?
Just,
So go there and hit F5. So from there, now hit F5 and add $70.
I just have to, that's what plus. Oh, no.
Yeah, you're fine. You're fine. You hit 70 and then hit enter. There you go.
671.
Yep.
Yes.
Okay.
That's
So, yep. Okay. So we're good there. Okay.
I think they're going a little bit of a mathematical error. No,
Well,
I still have 6670 or 6671. Even though I changed that.
okay.
Oh, just going back, I think we had to mention the first thing about the $900 state refund.
Mm-hmm.
I had my notes because we don't know what they did for 2016.
But we took care of that by overriding that on the page 1, 1040. We put in that 570. Okay, so go back to your Schedule A. Yes, you're on your regular Schedule A. Jim, go back to your regular Schedule A.
Oh, he had the different income tax.
Okay, what did you have for medical? You had 4140 now, right?
4104.
Yep. And then taxes paid?
Taxes paid, I had 4,072.
Go all the way to line 9.
Line 9, 4104.
Line 9.
Oh, I'm sorry. 7967.
Okay. What do we have on line 15?
15, 6765.
Okay. Line 19.
4600.
Okay. All right. Okay, so what was your total itemized?
23436.
Okay, so we're on the same there.
Isn't that
Okay.
something?
All right, now go back to 1040, page 1.
Okay.
Okay. All right, now let's, what do we have for income?
Oops.
Line 7.
77727.
All right, and we got 570 on line 10.
570 on line 10, which is
Okay.
still great for me.
Yeah, that's fine. Let's stay great. Okay, so go all the way to line 37.
37 is 78297.
Mm-hmm. All right, go to page 2. Okay. All right, and what did we have on line 40?
23,436.
Okay, and you had the exemptions of 1620, correct?
1620.
Yep, so keep scrolling down. We had line 52.
52 is 2,000.
Okay, keep scrolling down. All right. Okay. And what do we have on line 64?
9547.
Okay.
You don't have it.
Yeah, so what is your amount on line 75 say?
6678.
Yeah.
It just changed. It
Maybe,
was 6671.
maybe you hadn't hit enter on something and you switched the pages, so.
And
So you're
my
good.
state is still 1735 at the moment. You're
That's right.
1739.
No, oh, yeah.
What's your state?
1735.
Oh, 35.
Yep, yep.
You're right.
Yep.
You said 9, that's fine. At least I heard 9.
All right, so you're good there. All right.
Right on the state.
So it's 9.
Okay.
Okay, so then what?
Refund thing.
That's what it's out. Yeah, stout was fine for me.
Stout was my.
That was just mine too. Okay, so.
Yeah.
Great. That wasn't bad. Wasn't too painful.
So like for 2018, just they raised the standard deduction, it'd probably be just a lot less itemized.
Yes, but
But you're still gonna need it.
it just depends where everybody's at. I mean, it's hard to tell. You know, the software is still going to have the same thing. It's going to have a little different what we're going to talk about today with the bottom half of the Schedule A. But yes, 2018, you would think in theory that they're trying to get away from itemizing. That's the way they can shrink it to the postcard. But again, the way you have to do it, though, you still have to do the exercise of going through it to check for the client, because there might be some things that have changed where they would get something extra someplace else. But yes, the cap of 10,000 on that taxes paid, and you know okay, so we have that one. All right. Okay.
So with the Empire Child Tax Credit, we always subtract that off of your refund.
Yes,
They don't have to claim that.
because it's
You don't
refundable.
program?
Yes. Yep. Because it's a refundable credit on the state side. What's that? It's one of those things you just got to know from the tax law. And like I said, you know, that's going to be a big thing with 18 tax year, because the state may really start to play by some different rules. You know, we used to have the things where, you know, such that we could, you know, make an easy transition from the federal to the state, but I think we're going to have to be much more conscious. I think there's going to be a lot more instances like the 414 HSUB where we're going to have to know the two laws to be able to make the consideration back and forth. So, all right. Okay. All right. Let's go through the quiz from chapter 10. Any questions on any of the exercises? I'm sorry, I should have asked you that first. 10A, let me ask you what you got on that one, because that's kind of a good little one to kind of talk about. It talks about some who can take the deductions. It's at the bottom of page 10.8 in the textbook.
It's basically whoever paid it. That's usually the rule of thumb.
Exactly.
The person that paid it
When we're on a
gets
cash
it.
basis, yes. So,
So then the husband would do it on the first.
yep, so the husband, they're married, and it's married filing joint. The second one, Joe and Sandy Thomas incurred medical bills of $56.75 for their dependent daughter. Kelly was in a car accident. She was no longer a dependent in 2017. The Thompsons paid the bill in January of 17. Can they deduct this amount on their tax return?
Yes.
Yeah, because again, cash basis, when was it paid? Okay. Jim West is divorced. His former wife, Mary, is custodian of their son, Scott, and claims him as a dependent. Jim paid $430 doctor bill for Scott when Scott fell and broke his wrist. Can Jim deduct the expenses? Yes.
Yes.
Yep.
They paid it.
Yep. You're non-custodial. So, those are things that you have to make sure that you understand with those medical. Because sometimes people don't think about medical if that person's not on their tax return. Okay. All right. Okay. Let's see here. Let's see here. The other ones were kind of good as far as just the what can and can't be deducted. Did any questions come up on those?
Yeah, number 5.
Number 5
I
on,
know it's D, you have to create an adjusted gross income, but why can't you do itemized deductions before you figure out the adjusted gross income? Why can't you just have it done, ready to go?
you can.
You'd only have to worry about the medical of a couple of the adjusted gross income, but you don't have to fill that in later.
Well,
It was basically saying,
basically what they're saying is there's a couple thresholds that you have to use on the itemized that, you could look like you're itemized and then all of a sudden you're not, because those thresholds of the 10 or the 7.5% on the medical. And then we're going to talk today about the 2% on the job expenses. Those two thresholds, if you don't have the AGI accurate, then what you calculate on the Schedule A is not going to be accurate because of the threshold. So is basically what they're saying on that. Yes, you could. There's no reason you can't.
Eyeball it for the customer to say, can I itemize? They look at it and say, well, let's look. Well, I can see you have this going on, okay, but your W-2s are pretty high up there.
Yeah.
Now we're going to get the medical. So I already just did the.
You can do the rough math.
Or talking about, okay.
Yeah, but you don't know till you see it all meet each other, because there may be other things that come up on the Schedule A that you're not aware of. So, okay. All right, so let's hit the, let's see here. Got some good calculations. A lot of things Carrie in doing a Schedule A the first half. Again, showing you how the calculations work, okay? So let's go to the quiz. Any other questions on the exercises before I go to the quiz? All right. So let's hit the quiz in Chapter 10 on page 1052. Okay. All right. And Jim, you want to do that first one, number 1 for me on the quiz?
Yep. What is the percentage used to determine the amount of medical expenses allowed, and what is it based on? 7.5% of your adjusted gross income.
7.5?
Yep.
Yep. Okay, number 2.
Amy paid her mother's hospital bill. Her mother's not her dependent. Amy can deduct the hospital bill as a medical expense on her return because she paid it on behalf of a family member. True.
Okay. All right. And number 3.
Of the following medical expenses paid by George during 2017, how much can he deduct? D, all of the above.
Yep, everything that's on there. Okay. Mary Ann, number 4.
Which of the following is a medical deduction? A, legal abortion.
Okay. All right, number 5.
Interest paid on the mortgage of a taxpayer's first vacation home is deductible. True.
Okay. 6.
Taxes deductible as an itemized deduction include all the following except C, taxes paid on property owned by the taxpayer's parents or children.
Exactly. Cash basis, we didn't pay them. So, all right, and the last one, Jim.
7, money or property given to the following is deductible except B, the civic leagues and chambers of commerce.
Yes, you cannot write off things that you're trying to sway the opinions of people.
Let's go back to C for a minute.
Mhm.
If I paid my daughter's property taxes, I can claim it on my thing? On my Schedule 1?
Your daughter's property taxes. No, because it's not in your name.
Pardon?
It's not in your name. So,
So it doesn't.
Yep.
So it doesn't matter if I paid it or not on that one. Yeah, the property tax has to be money.
mhm.
And you only do it on the principal residence.
Yes. No. Nope. All right. So let's head into chapter 11. Okay.
Other book.
You had to bring the other book.
I know.
It's pretty heavy today.
And get a U-Haul to get here.
Sorry, I should have reminded everybody, bring your other book.
No.
So, all right. So chapter 11, we're going to go through basically the second half of the Schedule A with itemized deductions, okay? If you remember, where's my friends, the Boyds? Okay. All right, so we kind of did the top. We did those first 2 sections. We did medical and dental expenses. We just talked about in the quiz, that's 7.5%. As Mary Ann said, you can kind of ask them from the outset, did you have out-of-pocket medical expenses in excess? And you can kind of ballpark it, so that you know. A lot of times you would hope, but if people have, major medical events, they could possibly have something there. We got the taxes paid. We talked about real estate, state taxes. The general sales tax one, the little worksheet that comes in there, you're going to want to do that if you have somebody that is retired and had a major purchase, motor vehicle purchase. The reason I say that is because most of the time on our pensions, what do we not have?
State tax.
State tax withheld because it's not taxable on the state side. So the general sales tax, because if they're close, you're going to want to make sure you do that calculation on the sales tax, especially if they bought a car or, they decided to buy an RV and take off or something. Okay?
So you can have actually A and B then?
No, you have A or B.
Then
Oh,
you would have the A.
But what I'm saying is that if they don't have anything in A, you want to do B because it's going to do the tax. We have the property tax. We talked about interest. Make sure that when you're going off that 1099A, that you look at points and look at mortgage insurance premiums, okay? Because those are deductible. Remember I said that the mortgage insurance premiums halfway through the tax season last year when the law for the 2018 tax year was passed, they put this back in for 17.
Will it be on 18?
It will be on 18. Yep. Okay. It will be on 18. All right. This little section in here too, if it's the case that somebody's holding your mortgage, why do they want to know that?
Because then they have to owe.
Because they're going to have to declare the interest as income. Yeah. So the IRS is looking for 2 sides to the equation. Okay. And then we talked about charities. All right. We talked about charities in there. Remind me when we go through problem today, when we do some of the other ones, that we'll talk about that 82, 83. I had in my notes that we would talk about that today. All right. So we're going to get the bottom half. We got casualty and theft losses. We got some job expenses, and we have other miscellaneous. Okay. So basically, we're going to do the bottom half of our Schedule A. Okay. All right. Okay. So we are Okay, so chapter 11. If we go in there to page 11.3, we got our objectives. Like I said, we're going to talk about casualty or theft losses, and compute if we can take the deductible losses, and talk about the form 4684. We're going to talk about a little bit about net operating losses, and we'll talk about that. Business expenses, we're going to talk about the 2106 EZ. Again, you know, these are expenses, some of this 2% area and this threshold, these are ones that we had before, and they're going to disappear for 2018.
Oh,
So
that's gone?
the 2%,
Oh,
work-related, yep.
the 2% or just,
The whole section, basically.
oh, really?
Yeah. So that job expenses and miscellaneous, that whole section in there that was subject to 2% of your adjusted gross income, that's gone for
Is your
18.
home office too?
Yep. W-2 employees, traveling salesmen, over-the-road truckers, union dues.
Private practice?
Not if you're an independent contractor. You still get that on the Schedule C, which that's one of those things that you hear Esther talk about on the radio. Makes no sense. How can somebody that basically is the same type of employee, type of expenses, and one's paid on a W-2 and one's paid on a 1099, how can they get to deduct different things?
The W-2 person could possibly have another office provided by the employer.
Well, but
The other one will not ever have.
home office set aside. I mean, it's just the mileage. If they're not reimbursed for mileage, yeah, they're,
Yeah.
you know, you got a traveling salesman that drives, you know, my wife, what she does is a representative for a company as a W-2. Thank goodness they provide her a vehicle because she drove 38,000 miles in the last year. If she was not reimbursed or they did not provide, we would not get to deduct at 54 cents or, you know, give or take a mile. We would not get to deduct that. However, if she was paid commission on a W or a 1099, we would get to deduct it. That doesn't make any sense. So it's just a strange one. So we'll talk about that. Work-related education expenses. We'll talk about some of that, like I said, subject to 2% and not subjected to. All right. And we'll talk about the overall itemized deductions. All right. So the first thing we're going to get into is that casualty and theft losses. All right. Actually, we saw a lot of these last year. Can anybody think of anything that happens or has happened recently? Mary Ann might know this one.
That's her.
Oh, the flooding, or else this winter storm.
Which one?
You saw it last year?
We saw it last year. What was going on up on Lake Ontario?
The flooding,
Oh.
The shoreline. Yeah, and the shoreline, all that stuff. So there's a lot of that that was, you know, subject to, you know, that was subject to being able to do this loss on this. Okay. All right. Okay. So, and it talks about deductibility depends on which category the event falls into. Was it personal use property or business and income producing property? Okay. All right.
So, like for all these people out in California, if they got insurance with the deductibles 10,000, that's what they'll end up.
Exactly. Basically, you know, you have to make sure that you record the out of pocket. You know, so, you know, that's where, you know, that's the big caveat there. So.
You have to do that with a deductible on your car also. Right? If you had an accident with your vehicle, and let's say your deductible is $2,500.
Yep, but what, from your reading, what do we have to surpass in order for it to be deductible? Do you remember?
Fair market value of it?
Yeah.
No, there's something else. It's another threshold. And what typically do we have as a threshold? What number do we use? You asked about it earlier. No,
Appreciated.
no. What about our income?
Our adjusted gross income.
Yeah. Did you remember we're doing the reading where you talked about you had a threshold?
For a car?
Well, our deductible casualty losses is damage, destruction, or loss of property resulting from an identifiable event that is sudden, unexpected, or unusual. Okay? Talks about examples. It says car accidents, earthquakes, fires, floods, government-ordered demolition or relocation of a home, hopefully. Mine cave-in, shipwrecks, sonic booms, storms, including hurricanes and tornadoes, terrorist attacks, vandalisms, and volcanic eruptions. Okay? And I'm sure there's many others that we could probably fill in the blanks with there, but that probably pretty much covers the major ones. Okay? A casualty loss isn't deductible if the damage or destruction is caused by the following. Accidentally breaking articles such as glassware, china under normal conditions. Okay? So if you drop a glass or you knock over the china cabinet, probably not, well, I have to kind of look at the detail on that one. It's probably not a good example. If your family pet did something, so if you got a new puppy and he chewed up all your couches, all right, probably not going to be able to deduct that. All right. And it talks about some other ones that, and the other thing too is, you can't write off the loss if there's, it's sudden and has to be major. Things that wear out over time because of something, that's a little bit different. Okay. Theft is taking, removing of money or property with the intent to deprive the owner of it. Okay. I had somebody the other day that I did a return for. We went back and forth. They had a loss. They invested in a natural gas and oil in Kentucky, Tennessee, a partnership, and found out that the guy that was selling it didn't exist. He was taking the money. So it was a capital loss, so it was on a Schedule D, as opposed to being a Ponzi scheme where it would be theft. Okay, see where it says Ponzi type investment scheme? So we had to really get a background. We had to look at the court case, and it showed how they did the court case to find this guy. I don't think they've ever caught him from what every indication is, but that's where, you have to, distinguish on sometimes when you get into money losses, whether it's a capital loss because you invested in something, or if it was actually a theft like a Ponzi scheme. So you have to make sure you distinguish between the two. Okay. And then it talks about loss on deposits. All right. Okay. All right. Proof of loss. Obviously, you have to prove things. Okay. All right. Okay. If you go to 10.8, deducted loss recovered. If amount deducted as a loss in an earlier year is later recovered, the amount recovered may need to be included in income for the year of recovery. So basically, if you have something where you think it's a loss, and again, Ontario, the shores kind of come in because everybody was taken as a loss, but what happened later? Especially in an election year, the governor kind of came in and said, hey, I'm going to give everybody that's a victim of this $10,000. Well, all of a sudden that, yeah, and I know, it's just a theory. In theory, he spoke about it though, didn't he talk? He stood right there on the shoreline with that big crane behind him and
Even allowed us to fill out all the paperwork.
yeah, exactly. Filled out the paperwork, but just the money seemed to me not be there all of a sudden. But that would be the case that all of a sudden you're reimbursed for something, then that changes the game as far as what you have that is deductible.
So then would you use that as income? And hit ordinary?
You have to change, add that back in as income. Yep. Okay. All right. It talks about calculating the calculating the loss. Determine the deduction of the casualty, theft, or loss. First figure of the loss, amount of loss. Okay. Again, it's one of those type of things that you have to have a value. You adjust the basis. If you think about, has anybody ever had an insurance claim because of some loss like this? What do they come in and do? They take inventory, and then the insurance guy does what?
Actually praises it all.
Praise it, fair market value of everything. you know, and then talks about the cleanup and gives you, it says we're going to give you X number of dollars for Service Pro or whatever, you know, so all that things that are coming in. So then they say, well, we say that there's $18,000 here of loss, including value and cleanup, and here's your check. You know, so when you get a check like that, you're going to be able to write it off on your taxes? No, because you've been reimbursed for the loss. Okay, but if it's a case that it comes straight out of your pocket,
But if they subtract the deductible off, they can do the deductible part.
yep, it's something that comes out of your pocket, yes. Okay. Yeah, I helped a lady the other year, and it was, I guess it was 2 years ago now. She was standing at her kitchen sink, and they had been going back and forth with a neighbor about this tree, and this huge branch fell off the tree, hit the house, and basically her standing at the sink, she was not hurt. She was knocked over and stuff, and the tree branch fell in the kitchen right behind her. And there was a lot of things that they had to try to get the value and stuff like that to determine for it. You know, and they kind of went back and forth with the insurance company because the tree was not on their property. It was a branch hanging over of a tree from their neighbor's property.
So they want them to go after the neighbor?
I don't know whatever came of it, but we kind of had to kind of go through things because there were certain things that the insurance company would not cover that, you know, they had done as far as inventory of damaged goods. So we had to really look at it close. Okay. All right. Okay. So reporting the and calculating casualty, theft, or loss. We're at the bottom of 11.9. Okay. Casualty and theft loss of person property is deductible on Schedule A after completing the Form 4684. All right. And you have to use a separate Part 1 for each loss. All right. And the loss must be reduced, as we talked about, insurance reimbursement. For person whose property, $100 per instance, and 10% of the AGI after combining all casualty and theft losses for the year. So again, when somebody has that, and you were talking about the deductible, a lot of times, you know, if somebody makes $100,000 and they have a casualty theft loss, well, we have to exclude the first $10,000 because of the 10,000 or the 10% of the AGI. And a lot of times deductible, if you have insurance where you have a $10,000 deductible, yeah, it's probably not very good insurance. So, okay. All right. And then for employed property used in performing services as an employee, it's 2%. So it's a little bit different. Okay. All right. And then it has a great little table at the top of 1110 that talks about, and kind of each column goes through the $100 rule, the 10% rule, and the 2% rule as to how things are applied. Okay. And then also that table 25.2, when to deduct a loss. Okay. Again, kind of goes back to what we were talking about when the loss happened, when the insurance settlement, all of a sudden later we got income from it. Now we have to go back and adjust and correct. So, you know, make sure you realize that just because in a year there may have been this loss, it doesn't mean that it's done, that it's behind you, because the next year, if there's something that comes back where there's a reimbursement on that previous loss taken, you got to go back and adjust it.
Let's say if it was November, December when it happens. By the time you really figure it all out, it's the following year anyway. Then you take it in the following year.
Well, yes, you would, because that's probably when the insurance settled.
It's going to take a while for everything
Yeah.
to take in.
Yeah. So, you know, again, you could take it in the year and then go back and amend if you want to. Because the loss happened in that year. So as it says here, for casualty, the loss to deduct it in the year the loss occurred. So you take it knowing that you might have to deduct it and amend the previous year back. So, you know, really you should file it on the current tax year, but just know that if it happened, you know, Christmas Eve, you know, Santa broke your chimney and you got to get a witness to say that it was Santa that came down your chimney and broke it. Well, it's probably going to take some time. But if that's the loss that you had, okay, I don't know if, would that fall under casualty or would that fall under theft if Santa's breaking your chimney coming down? Well, I guess he's leaving stuff. He's not really taking, well, he took the milk and cookies. So that would be a theft, right?
I was offered them.
That's true. That's true.
That's an offer.
All right. Well, we might have to do a little research on Santa breaking a chimney. Probably not a good example, right? So, okay. 4680. Yeah, that's right. Yeah, that's right. You know, yeah, you know, I keep trying to get him to file that Schedule 8s for all those little household employees he has running around up there, but for some reason he's gotten out of it and the IRS is not going after him for Schedule H. So, all right, 4684, again, you know, you might see one of these a year, give or take, you know, just kind of understand the form. But, you know, again, you know, Mary Ann talked about earlier that kind of that ballpark in it. You know, you get somebody that's got a pretty high AGI, and as soon as you do 10%, you're going to say, are your out-of-pocket losses greater than X number of dollars? You know, so that's the first threshold. The second one is they got to itemize. And again, you know, this has not changed for 2018, but, you know, now we have a much higher threshold for the standard deduction. So again, you know, ballparking it and kind of understanding that, you know, the number, because if the only thing that they had to do, okay, was satisfy this and the standard deduction for 2018, so we would have to make 200, if it's a married filing joint, they would have to make 240,000, and their portion of the loss would have to be above 10%, would have to be $24,000. So if you think about that, that's a huge loss. And not to have insurance of some kind covering that. You know, you're probably, maybe an instance of that with somebody with that type of income would definitely maybe be a Ponzi scheme. You know, where they would have it.
When you lose your home, and the insurance company will say, we're only going to give you a certain amount of money, and you say, but wait, we have to rebuild it. This is going to cost this much to rebuild what we had. Yeah, but again, you know, when you're talking about that higher standard deduction, that 10% rule, you're talking about a huge out of pocket. But 9 out of 10 times your home is worth a lot of money. Yeah, but
your insurance, you need your deductible would have to be $25,000-$30,000.
Yeah, you're out of pocket.
Right, but what if the insurance company doesn't reimburse the whole entire, whether it's a deductible or not? We had a friend that their house burnt down and they didn't get their full market value for it. The insurance company,
said it was less. Well, then the IRS wouldn't accept something higher.
Well, again, you'd have to do a lot of proof, because sometimes when the insurance company does that, if you can't support any improvements that you made to the home.
A lot of times is when the insurance company, when you insure your house for, let's say, $60,000, because that's your mortgage on it. It's not what it's worth, but that's what your mortgage is left. House burns down and it was actually worth $120,000. They're only going to give you the $60,000 because that's what it's not. Well, what about the other $60,000?
But again, you know, with the insurance, if it depends if what they feel it is to rebuild is what they knew the value was. Because that's kind of different insurance, because if you're, you know, you're insuring the mortgage versus the structure.
You do that.
Yeah.
Because it's cheaper. That's all they can afford. So they will only do what their mortgage is worth.
That instance is pretty narrow.
Okay.
Yeah, that's pretty narrow. You know, because again, you know, when you start looking at the fair market value, you know, that's a tough one. You know, because like I said, you know, even in that case, that $60,000 difference, you know, it may exceed the standard deduction by $3,000 or $4,000 when it's all said and done. That's going to help them on their taxable situation. And then again, it's a deduction. So it's only lowering their taxable income. It's not a credit, dollar for dollar. So when it's all said and done, it might help them $500 or $600 on their tax return. You know, even in that scenario with the $60,000. Yeah, because it's not a dollar for dollar. And it's a deduction that is over a threshold too. So, you know, like I said, there's a lot of times that, you know, it's hard to get this loss. So, okay. I did have one gentleman that I did help with something like this, but it was more of a business sense. Landscaper, he was renting a building, and he didn't have insurance on his equipment, and he come to find out that the landlord did not have insurance on the property either. So he lost all of his equipment. And he had to basically stop the firemen from cleaning things up so he could run around and take pictures of everything that was in the building. That was, some of it was roughly identifiable, other stuff, you know, it was just kind of a melted. So yeah, so that one's tough. So, all right. So you have some exercises on those losses. Okay. All right. And you'll do a little bit of a, you know, calculations. Looks like, let's see, who is the gentleman here? Jared had his home broken into on the top of page 1114. So that'll be a good one to talk about that theft. Okay. Net operating losses. We're just going to skip this one because it gets a little involved with the net operating losses. You're not going to see many of those. So we're not going to worry about the net operating loss. It's good reference in there. Okay. 1117, we have employee business expenses. And this is where we start to get into those categories that we have 17, here's our tax, 18, this disappears. Okay. So as it says there, employees may be able to deduct ordinary and necessary business-related expenses for travel, entertainment, gifts, and transportation. An ordinary expense is one that is common and accepted in a trade or business. A necessary expense is one that is helpful and appropriate for the business. An expense does not have to be required to be considered necessary. Okay, everybody get that paragraph?
Yeah.
I think about the last sentence.
Yeah, exactly. Okay. All right. We're going to talk a little bit about the 2106. You know, basically that is a form that you'll see in the software, but you have on there that talks about calculating everything. It's kind of a similar to a Schedule C, but a little bit different because it's for a W-2 employee. Okay. But it is part of the Schedule A so that we can do those deductions on there. All right. And what must any of those expenses exceed? 2%. Yeah. That's where, you know, a lot of people have this image of nothing else. If I have a couple people that work at the Delphi plant have high union dues, oh yeah, we get to deduct our union dues. Well, yes, you do, but they're not enough. Even though, yes, they're paying $1,100 a piece for union dues, it may not exceed 2% of their adjusted gross income for it to count. Teachers, the same thing. Teachers pay huge union dues, but if their income and their salary is $90,000, $100,000, it's not going to help them. Okay, and again, this is one of those sections that just disappears. All right, travel expenses. Travel expenses may be deductible when the employee is traveling away from their tax home for business, profession, or job. As it talks about here, that the employee is traveling away from their home when the duties require the employee to be away from the general area of their tax home longer than ordinary work days, all right, or sleep or rest. Does everybody understand how the tax home works?
It is a little confusing.
The best way, and I think he has it in here, unless he took it out,
Especially when you get two jobs.
is this little guy right here. So if you go to 1123, there's a little what looks like things out of Monopoly. So we have our regular main job, and we're going from home to our job. Okay, that's a commute for a W-2 employee. All right, so that is never deductible. Okay. Now, if we go from home directly to our second job, that is not deductible, okay? However, if we left home in the morning, we go to our job, and then afterwards we're working nights at EG Tax, from our main job to our second job is deductible.
Only if you go directly from it. So go back home have a bite to eat, and then go to EG tax, it's not deductible.
Yep.
Vegas.
What's that?
Brown
They
bag.
go shopping and
You know, we had, when I was up here, I had a young lady that worked for me that was a prison guard. You know, and she'd come in her prison guard garb and, you know, go in the back and change clothes and then work nights here. And, you know, that way, and then she kept track of the miles. So obviously I knew she was coming directly from there because she was dressed as a prison guard. So, and then you can see there that, you know, going from your regular job to a temporary work location, okay, that would be deductible. All right. So basically what I'm talking about is if I am a plumber, let me ask you this question. So if I'm a plumber, I leave home and I go to the shop, okay, and I use my personal vehicle when I leave the shop to go do jobs at this spot, and that spot, and another spot, and then go home. What about those miles from where I work, my main place of employment?
Deductible.
Wait, what did you say?
They're deductible.
But not going from home to your
First-
shop,
The first,
but from the
Part of it.
shop to all the other.
Yeah,
ones.
so if I always report to the shop every morning, but then I go do it on my, you know, my personal vehicle and I go work jobs in my personal vehicle, what about those miles?
That's tough.
Mhm.
Like therapists, like DNA and all that on the road.
Yes, but you have to be careful because when we talk about travel miles, what a lot happens with the VNAs? What's in their pay?
reimbursed.
They're reimbursed for part of their mileage.
Oh, are they?
So, you know, my wife's old job that she had as a sales rep prior to this, we had to use a personal vehicle, and they would reimburse her for 25 cents a mile. So what's that mean? I don't get the full mileage. I only get the difference between the reimbursement. Okay. All right. And, you know, work expenses too, when we go back up, I was talking about, let's see here. Gotta go back up here. We got talked about travel. So tax home, we just kind of talked about there. Meals, be careful. Okay. Be very, very careful. All right. Stopping at Tim Hortons on the way to work and sitting with your laptop is not a deductible meal. All right. However, if you stop at Tim Hortons and you meet with a client and you pay, is that deductible? But how much?
50%.
Yes. Believe it or not, the IRS has determined that you must eat. Okay? You cannot write off nourishment and to sustain you as a life form. You know, the IRS is cold, but, you know, they have required that you must eat. So half of it, which basically means you can't write off the food that you eat. Because the IRS has determined that you must eat to be alive and be a taxpayer. Okay? All right. There is for some travelers, there is a per diem, like an over-the-road trucker. If you go into, let's see here. Okay. If you go into our tax book, there's a section right out of the gate that has a per diem. Okay. Basically what that per diem is it's meals, incidentals, and such that you get to deduct. And sometimes you do it based on the location. Okay. So even if I look under this, the per diem for 17 for Buffalo is $64. New York City is $74. Okay. So, you know, you just know the cost of living. So an over-the-road trucker that maybe is doing nights and stuff like that, you have to kind of add up their per diems. You know, so I'll sit down with an over-the-road trucker. How many days out were you? Well, I was out 240 days of the year. And that's not uncommon. You know, and if they're not reimbursed for those things, then they have some things that they can do as a per diem while they're traveling. You know, and obviously if it's an over the road, are they getting a hotel? No, because they have DOT hours and they have to stop, and where do they sleep? In the back of the truck. So it's not fair for them not to get to deduct because they're not going to the hotel because they have to rest because of their DOT time. And the DOT restrictions is creating havoc on transportation, trust me. You should hear my wife every morning. What do you mean the truck? He's sleeping at a rest stop. He has to. He only can drive for a certain number of hours. My wife always goes, so? Get him up. But obviously, what's that for? Safety, all right? So, yeah, my wife's not real sympathetic when the trucks don't get to where they're supposed to be, so. All right, so that's where we talk about that with a per diem. So the travel expenses, it talks about the ones that you can deduct. They're in that little chart at the top of 1119. Okay, entertainment expenses. All right, this one has gotten where it's just not even worth trying. Okay, remember the days when everybody could write off their membership to the country club? Yeah, those disappeared in a hurry. So, yep, that disappeared in a hurry. So, all right. Okay, as it says here, the following trips do not meet the direct related test: fishing, hunting, yachts, and other pleasure boats, as business is not considered the main purpose. All right, so in the middle of 1120 there's a little thing that talks about directly related test. All right, okay, and again, we have that 50% where we talk about the limitation there. All right. At the top of 1122, it talks about the deductible entertainment expenses and non-deductible. All right. And again, what they're basically trying to say there is the entertainment situation, did it allow business to be conducted? You know, again, if I'm out fishing, what's my focus?
Fish.
Fishing. Well, if I, well,
Would be for me.
you don't like to fish?
No,
Or you don't like being on the boat?
no, fishing.
Okay.
More.
All right.
Something else. It would be business then for me.
Yeah. So, but you know, that's where you have to make sure that,
They always say that on the golf course, you know how many business deals are done on a golf course?
well, the thing about golfing is you have to remember, mathematically, a golf swing takes probably right around a second. And if you shoot 100, that's 100 seconds that you've been swinging the golf club. Okay? So how many minutes is that?
Not even 2.
About 2 minutes, right? Okay. Now we'll give you 3 or 4 minutes to line everything up, so that's another 300 minutes. So how much is 300 minutes?
300 seconds.
300 seconds.
Well, yeah, we'll give you half an hour to get the club out, get situated, lined up, and everything like that. So we're at 3 minutes, or excuse me, 32 minutes, we'll say, that you're actually playing the game. How long does it take to play a round of golf?
3-4 hours.
Yeah, so you got 3.5 hours of downtime.
Same thing with fishing.
Well, it depends. Depends how your guide is.
You can just sit there for hours. You got a lot of downtime. Football game's the same way.
Well, depends what game you go to.
Yeah.
If you're going to a Bills game, there's a lot of downtime.
What they always say with the playing time of a game,
Oh, yeah.
15 minutes out of the full
Yep.
3 hours.
Yep.
There you go.
Yep.
So it should all be okay.
Yeah. So, all right. So gift expenses. This is a big one too. This is why every time you get from someplace you go that you get a $25 Tim Hortons gift card. Because if it's $30, how much are they going to get to deduct? 25. Okay. All right. Transportation expenses. Again, we kind of talked about that a little bit. Had our little chart there. Okay. All right. Car expenses. If the employee uses their car for business purposes, they ordinarily can deduct car expenses. Generally, one of the two following methods can be used. Okay. We can use the mileage rate or the actual. And I will say 99% of the time, getting your mileage rate is the much better deal. However, sometimes people have cars that actual is better because why? You got to maintain it to keep it on the road. But once you choose a method, I can change, right? And take the best deal each year? No. As long as that car is in service for me, I have to stay by the same method. So that's where a lot of times people go, I want to do actual. I kept track of every gallon of gas and said, okay, what's your number? Well, here it is. I said, Here's my number at 54 cents a mile. They're like, well, I want your number. I like your number better. Yeah, okay. All right. All right, so we have that. As it said, 17 was 53 and a half. 18 is going to be 54 and a half. Okay. And again, you know, you can try to keep track of actual. They're always going to miss out on something. It seems like it never fails, but you know, it's a much better deal to do the mileage.
With the debit cards nowadays, you have a better
Yeah,
deal for that.
yeah, you do. But again, when you start adding everything up, oh, I had to buy new tires this year. Okay, that's great, but you know, your $400 set of tires, you know, that doesn't amount to much. Okay, because if I take,
It's like 800 miles of driving, which is nothing.
okay,
So for those that have properties, usually they're in smaller range.
hold on one second here.
Going to and from a property maybe 2 miles.
No, because you're still keeping, you wouldn't have as much gas use.
But you still have to put the tire, still have insurance on it, usually truck
Okay.
insurance.
Well, but the tires, okay, if I was going to use that as miles, that's only 825 miles if I had a $450 set of tires. You can drive 825 miles in a week. You know, like I said,
Right. So it depends on what your profession is.
mhm. Like I said, you know, you look at my wife, what she does, and like I said, thank goodness they provide the car, but she drives roughly 730 miles a week. So that set of tires is almost equivalent to 1 week of driving for her. She's got 51 other weeks that we can get the mileage for. So again, you know, when you start equating it, the actual, yeah, and the thing that you know, it's just like they did with the home office. When the IRS comes in and gives you a standard rate, they're probably being a little generous and they want everybody to be there, and it's easier for them to audit because if the miles seem really out of kilter. A lot of times they would come in and do a standardized rate because everybody was abusing it. That's why they did the home office that way, because people were getting away, you know, they were just writing off expenses for home office that didn't exist. Okay. Great little thing on 1125, record keeping. Okay. I'm going to do a little commercial plug here. EG Tax has an app, all right, that is free. And actually the app now has a thing where you can turn it on and it's set up to track your mileage. So for me, when it's in the car and my car is in motion, when I get done, it says, here's a recap of your trip. Is this business? And I say yes or no. And if it is, and I'm not being reimbursed for it, and it's not my ordinary commute, I can keep track of it. And then at the end of each month or whatever I do, it exports it right into a spreadsheet. And I kept track of my miles. Okay. All right. But record keeping is imperative. Okay. Because I have one right now that I'm helping some people with in the state of New York. They're now requiring us to have the employer on letterhead write a letter to justify the employee's miles that he's claiming on the return. So not even more so now all of a sudden the taxpayer's employer is involved in the audit. And the employer has to say, well, yes, we pay him this, we reimburse him for this, this, and this. And to see what, you know, also New York's gone a step farther, not just you producing logs and you know, when you get your inspection done, it shows the number of miles that you've driven since the last inspection, things like that, or, you know, credit card receipts, stuff like that. Now you have to go a step farther, and all of a sudden the employer has to justify what the employee did on their tax return. That's what New York's doing. Isn't that great? So, and you think that they're going to back off that if they're doing different rules and let you itemize more in 2018? No, they're going to. You know, to me, it just leaves a it leaves a loophole for New York State to delay giving refunds. If they're going to say, well, yes, we're going to allow more itemized, but we need more time to look at the return. You know, because they've delayed it in many ways, and that's because a lot of times it's just, I don't think that they have the money in the coffers to pay the refunds. All right. You know, they got to move it around. All right. On the bottom, 1128 talks about some unreimbursed employee-related expenses that we don't have to do this 2106 that we've talked about. Union dues. Sometimes I have mechanics that are W-2s that they bring in their little Snap-on or Mac tools or whatever. And boy, those two companies know what they got to do because they give it a printout and it's got it all there. And tools aren't cheap, okay? Drug test, physical examinations, dues, subscriptions to professional magazines. If Marianne has to do Hand Therapist Digest, I guess, I don't know what to call it, so, all right. Talks about things, the one that is on there, cost to look for a new job in the taxpayer's current occupation. So if I stop working for UG Tax and I choose to pursue another career in tax while I'm looking for the job, I can do that as expenses, okay? All right. Home office, again, be careful. Don't get crazy with it. And again, 9 times out of 10, it's a much better deal to take the $5 a square foot, all right? And that's for 17, 18, doesn't really matter, okay? Coach, cost of teaching aids, supplies, and equipment. This is one, best example for me on this one is I had a client that, she still comes to me just because we discovered this, but I have a client that is a music drama teacher, okay? She's in a school district that has a very low budget for musicals. So she has her $250 that we're going to talk about in adjustments to income, but she also pays out of pocket for all the costumes and scenery for the musicals. Which,
Nice teacher.
yeah, well, just because she loves to do it and things like that. Yes, it is subject to 2%, but with her union dues and this, sometimes we can get a little bit of it back. Okay, I'm not saying I get her dollar for dollar everything she spends, but we get a little bit back. And depending on what the musical is, you know, I guess if it's Phantom of the Opera, she's got to do a chandelier or something, but, you know, so, all right. Work clothes and uniforms. Be careful, okay? The best example of this one is scrubs, okay? By right, those are what? But where do you see them? But where else do you see them? I can see them walk by here, probably half the people that walk by that may be in the medical profession. So you got to be careful because if it's something that you have to wear that's special to your profession and cannot be worn on the street, all right, you got to be careful, okay? You know, steel-toed shoes, safety shoes, things like that, yes, because that's a job requirement for safety and stuff like that, okay? All right. Okay, but you got to be careful on it. All right, we'll talk about the 2106 when we get into the problems. All right, got a few exercises here. Work-related education, so at the top of 1134. All right, employees that itemize their deductions may be able to claim a deduction for the expenses they paid for work-related education. Qualifying work-related expenses are deductible as an employee business expense. Again, subject to 2%, but they are gone. Work-related education expenses may qualify for other tax benefits, such as the American Opportunity and Lifetime Credits. The taxpayer may qualify for these even if they do not meet the requirements for this deduction. Okay? So, qualifying work-related education, they're in the middle of the page. Must meet at least one of the following 2 tests. The education is required by the employer or the law to keep the taxpayer's present salary, status, or job. The required education must serve a bona fide business purpose of the employer. Okay? The education maintains or improves skills needed in the taxpayer's present work. All right? Okay? So, down at the bottom, we got a little example there, okay? Or a few examples. Jill, a teacher, has satisfied the minimum requirements for teaching. Her employer requires an additional college course each year for the teacher to keep her teaching job. If the course will not qualify Jill for a new trade or business, they are qualifying work-related education, even if Jill eventually receives a master's degree and an increase in salary because of this extra education. Okay, does that make sense? Kelly, a sales clerk at a local store, took a tax class at the local college with the hopes of becoming a tax professional. Because this would qualify her to work in a new business, the cost of the course is not deductible. Okay, so your class that you're taking right now, is it deductible? Nope. Okay.
However, if it was the extra course that we're now by cancer, because a lot of them are working for EG Tax, they're required to take the course. So that would be tax deductible.
If it's criteria for your employment, yes. Okay. Dorothy, a tax professional, attended a week of seminars dealing with corporate taxes to improve her job skills. The cost of the seminars is deductible. Okay.
Sometimes if you have an associate's degree in business and accounting, you're an accountant for a company that says, no, we would like it really if you finished off that degree to maintain what you're doing and to understand what you're doing over at work. Is that deductible?
If it's this, you know, again, if it's related to you keeping your job, yes. Okay, that's the big criteria. You know, if you have to do it to keep your job, okay. You know, that's what it boils down to, is just making sure that it's a requirement. You know, if you're just taking it to get better and try to get a promotion, well, that's a little bit different. You know, you're bettering yourself. Okay. All right. Tax prep fees are deductible in 17, but they're not in 18. Okay.
That's good.
It's a postcard. What do you need it for? We don't need
Yeah, I
tax
mean,
deductible.
come on. It's what, a 37-cent stamp now for the postcard? You know, who's going to deduct that? And even if you type it in, it doesn't even round to 1. So, all right. Some other things that are on that 2%. Again, these are all ones that that you have. The other one that jumps out that we do a lot of is investment fees. You know, the other day when I was talking about our my day traders, you know, they have a huge amount of investment fees. You know, so, and it shows up a lot of times at the very back of their statement, way down on the bottom in a little teeny paragraph. This is what it cost you to have your investments. That's why you see some of these brokerage houses having these advertisements for, you know, dollar whatever trade. But now that investment fees and expenses, fine. No longer deductible. Okay, but for 2017, yes.
If you made money though, can't you deduct against that?
You can, yes, but this is the fees outside of what may be in the stock trades. Okay, so this is not necessarily what's included in the basis. Yeah, you're thinking of what we talked about with the basis that they take into account. This a lot of times is reported separate from that. So,
It doesn't really matter. Say it's not.
yeah, safety deposit box, same thing. Okay, now on page 1138, we have the deductions that are not subject to 2%. Those are still here. Okay, gambling losses. All right. Remember that for 17, those are describing the gambling losses. For 2018, you can include your transportation and anything else that you incurred to make those gambling losses. So if Jim decides this weekend to fly to Vegas and he loses $10,000, he can write off his flight.
If I lose $10,000, I better not come back.
Well, yeah, it doesn't say anything on there. I guess it doesn't, but you can only put it against your winnings. But yeah, it doesn't say anything. Well, that might be a casualty. Put that on a different spot. There might be a casualty loss there, right? So, okay. But it talks about these. Now, I'm going to show you in the software. The quirkiness of the software is you have to type it in very specifically for these non-2%. for it to e-file. So, okay. All right. And then it talks there on page 1139 about non-deductible. All right, for the non-deductible, okay? All right. An example down there, Carrie Dibbs paid her lawyer the following amounts. $4,000 for her divorce, $450 for a new will, and $2,500 in assisting obtaining alimony. She only gets the $2,500. Basically, those expenses are such you can only deduct things that are going to generate income. Okay? Is basically the way to think about those 2%.
Well, you need the divorce lawyer to generate that income, but the lawyer to
Yeah, you're
get
stretching.
more money out of it. And you need that. No, it's,
Nah, you're stretching. Okay. There is a limit on page 1141 on itemized deductions, so you can't go absolutely crazy giving to the church. Okay. And so there is, you know, those phase out, if you will. So if somebody's income gets above married filing joint 313 or single 261, you can see that there is a limitation there. Okay. All right.
it's more personal. So a business one wouldn't be on the itemized. So they would be able to do it full. Let's say at Friendlies, they own Friendlies and they donated Friendlies to the chapel. Because that's a business, that'd be on the business.
Yeah, we'll be on the business
They
of the
would be
business
able
now.
to deduct the fair market value of that building.
Quite possibly, yes. Yep. Yep. Okay. All right. And again, it gets into a little bit too, that's kind of a domino, if you will. When you start to get where your itemized are limited, you know, all of a sudden there's parts of that itemized that have limitations too. So you start cutting back. Another one of the examples is charitable. You know, things like that, when your income gets super high, then there's certain limitations on even your charitable contributions that make up your itemized. So, all right. Okay. And then there's a quick little section on the alternative minimum tax. Not going to cover that right now. Okay. All right. All right. So that's chapter 11. Okay. So let's take about a 5-minute break. I'm going to go get the coffee's back there, so you can grab a coffee. All right. And then when we come back, let's see, what do we want to do here for a problem? What's a good one? Okay.
Oh, I have a question for you on 1142. That worksheet that they had.
1142.
Number one, my figure is not 142, 140, as they have. Because it looks like you have to do lines 4, 9, 15, 19, 20, 27, and 28. They added 10, 11, and 12 in it too,
Mm-hmm.
to get that figure. That's wrong, right?
142, 140.
Right, to get the whole 142, 140 is also included interest paid lines 10, 11, and 12. But when you read the form, number one says enter the total amounts from Schedule A, line 4, 9, 15, 19,
Mhm.
20, 27, 28. Never
Yep.
said 10, 11, and 12.
Yeah.
But that 142 includes the 45.
Yep.
So it's incorrect.
Yeah.
Okay.
Yep.
It's kind of crazy.
Okay, let's see here. Let's see. Let's do. Let's do 11-1. We'll do Timothy. Just because I like the name. All right. All right, so as you come back from the break, if you want to start putting Timothy in there, we'll take care of that one, okay? Okay.
Get a lot of patience for all that. That's one of the last ones that I left out.
All right, so we have Timothy. All right. It's good. Age jumping out at you. It's a good thing to pick up on. All right. And 23, well. And he lives in the town of Tonawanda, where our new corporate office is. Here, an alternative route to come up here now. Yeah, it's just on Colvin, so it's not bad, but yeah, it's just a section going from Colvin to about the 990. That little section at times going to be a little dicey. So,
yeah.
All right, Timothy works as a security guard. As soon as you type that, what are you starting to think?
Yeah.
Uniforms. What else? He has a sidearm.
Tools.
Yeah, I suppose. You know, mace and.
So
Licensing.
Yep.
you can even do all that too, huh?
Well, if it's a requirement of his job, we'll kind of talk about as we go through them. It looks like he's single. Must work some strange hours as a security guard, so you know, no significant others and no. Okay. Yep, that's right. He worked as a security guard. So Timothy and his wife went through a divorce that was finalized in December. All right, and the bullet point. So what's that mean?
Same.
But he was married for most of the year.
The end of the year
In a year.
is determined.
Okay, good. There you go.
You can give a child December 31st, deduction for the whole year.
All right, so if he has a refund or if he owes any money, he'd like it done electronically. And oddly enough, we're still using M&T Bank. All right.
Oh yeah, some of mine, I was going through them, had a default of EG tax already in this. Some of them doesn't.
All right. I'm not going to worry about the driver's license. Like I said, we'll get a little bit more of that. All right. And you can't emphasize enough, make sure you're completing your main info sheet. Because if there's anything that applies that you need to make sure that you have that done so that it will lead over to it. All right. So he filed a 1040 last year. Timothy and his wife itemized last year. They received a $2 federal refund. So what do you think we're going to do?
Bill, they just didn't have to claim it.
I'm sorry, they received a $2 federal refund.
They didn't have to claim one?
A federal refund?
Oh, federal, I know.
Yep. Little trick there.
I was,
Yep.
I didn't listen.
Yep. You got to make sure you read your bullet points. So that are $2 federal refund. Okay. Timothy and his wife went through a divorce, so we talked about that. If they handle any refund, he wants to do it electronically. We're working on his main info. We got most of that in there for right now. Timothy won $500 from a scratch-off ticket. He had no other additional income. He had health insurance the whole year. And then we got a bunch of expenses that he has receipts for. So he did his bookkeeping. Okay. All right. So we have everything in there. Let's take a look at his tax documents first, and then we'll come back to his little list here. Okay. So tax documents wise, he has a W-2 on page 11.6. He has that from bank security systems. All right. So if he works for a bank and there's a theft at the bank, does he get to deduct it?
No.
Well, he's a
Unless he
security
owns the
guard, unless he owned the bank. So,
He gets fired.
yeah, probably gonna get fired. That's probably true. Okay. Okay. All right. Okay. He has in box 14, what do we see there? Okay.
Not go over to it.
And what else do I need to make sure I do when I put the United Way in there? What about that box about the 8880?
Oh, you have to undo it.
Yeah, make sure you undo it, okay? Okay. All right. If you want to go ahead too after the W-2 and clean up his ACA worksheet. He had health insurance all year long. Okay. All right, so everybody got their W-2 and ACA in there?
United Way, we can just type it in there, or do we have to do the other form
Type it where?
in 14?
Put it in 14 because you always want to recreate the W-2 in the software as it is appears on the piece of paper. But you're going to have to know you got to do what?
Put it in under
On
Schedule A charitable.
Yep. Okay.
No, I was just making sure that we didn't have to do another one.
Okay. All right. Okay, so everybody got the W-2 and stuff in there? All right, so most everything else, and considering what we spoke about the last two classes, where do you think we're headed?
Schedule A.
Okay. So what about the box in the middle of 1040 page 1? What do we determine we have to do there?
Oh, but then you itemize.
Yes,
Last year.
you did itemize, correct?
Yeah.
But he had no state refund, it was a federal refund. Okay. All right, so Schedule A.
Which means we'd have to undo that red for that 10. Or else we'll always have that little.
Yeah, red spot in there? Yep, you can just hit F3. F3 gets the red out. Okay.
I'll go back to it. Oh, really?
Okay. So first thing we're going to have, let's take a look at his statement from his mortgage interest. He had a 1098, and it shows mortgage interest, correct? So we're going to find that on his interest paid. So there on line 10, there's the one that says interest and points from his 1098 form. And wow, 6984. Must be early in his mortgage, huh? Okay. So line 10, there's one that says home mortgage interest and points from form 1098. And then we have some taxes, so we can go back up above a little bit. And on line 6, there's real estate taxes on his principal residence. Okay, so we got those. All right, so let's head back to 11.4 because we got all this stuff on there that we got to decide what to do with. Okay. All right, so we have cash donations to church. Okay, so we're going to start a detail sheet. We don't have one yet, but if I go down, well, let's tackle this first. 5B, let's take a look at his sales tax. Okay,
Oh, and then the charitable donation on W-2, you don't want to forget that while you're doing it.
yep, but 5B, let's go back up to 5B where we have our sales tax. Let's hit F9 and go do our little sales tax worksheet there. Always good to do, you never know. Line 1, what state is he in? New York, right? Okay. So, yep,
So
so,
you're down,
Oh,
halfway down.
yep, sales tax worksheet, I'm sorry, yep. So, you know, where you got the section, and start with the state. We go down, what's our letter that we enter there?
B?
B for New York, yep. Okay. Does your locality impose a local sales tax? Of course, we're in New York. And 4.75, he is in Erie County. Okay. And did you enter 0 on line 2 above? No, we did not. Okay. All right, so what did everybody get for his sales tax?
$7.99.
$7.99.
Okay. Oh, okay.
All right. And when we go back to the Schedule A and look at 5A and B, which one's greater?
Wait,
A, which is which?
Income tax.
same tax.
Yep.
Then you get to take it off.
Sales tax?
Yeah.
Nope, it just checked it. See the box next to the A?
It'll put in
Oh, then he didn't get
whichever
it.
one.
Yep, whichever one's greater, okay? All right, so back to 11.4 in our bullet points. Cash donations to the church. Now I'm gonna go down to my gifts to charity, and I can light up any one of the lines there and hit F9, and what am I gonna open up? So if I go to line 16, 17, a little detail worksheet. All right. Yep, and this was a cash contribution, correct? So under that first section, cash contributions, we're gonna type church. And we have $260, okay? And then what was the one Mary Ann made us not forget?
Anyway,
United Way. And that was off the W-2, and it was $532.81, better known as 533. Okay. All right. Work uniforms. Yay or nay?
Yes.
Okay. But he could wear his security uniforms out on the street.
good. And you're work your job.
Probably. All right, so we're going to go down to job expenses, okay? There's a couple different ways to put it in. So let's go on your Schedule A to line 21, all right? Okay,
Oh, we gotta go back to that.
Schedule A, yep, yep. And when we look at this,
Schedule A or Schedule A detail?
Schedule A, yep, Schedule A, line 21, okay? What we're going to do with this is, let's see here. For this one, we're going to do a 2106, okay? So see the line says amount from form 2106. Can light that guy up, hit F9, and I am going to go into the 2106. All right,
And why did you choose that?
just because I want to show you. Okay. All right, so we look at 2106. Top, it asks for his occupation. What is he? Security guard. Why do you think they would want that up there? Exactly. That's right. Okay. All right. He's working as a security guard, and if he's writing off a class identifying types of roses, probably doesn't apply. Okay. Yeah, might be a red flag. Okay. So we have work uniforms. Well, let's look at our enter your expenses here in part 1. Okay. We got vehicle expenses. All right. We'll talk about that. Parkings, fees, tolls, transportation, you know, fees, whatever. Travel expenses while away from home overnight. Business expenses not included in lines 1 through 3 do not include meals, okay? So, that's probably a pretty good one. So let's go to that line, hit F9. What's in there? That's about our only choice, isn't it? Okay? This is where you can use. Mary Ann loves scratch pads. Pat was the same way with scratch pads. Is that something in the house or the water you guys had?
That's what I told you about.
Must be something in the water.
He's a scratch pad. Why?
All right, so this is an instance where it's perfect for the scratch pad, okay? So we're gonna get a new scratch pad. And basically, this is something that is gonna carry forward with the return to show the detail, but is not gonna go in with the electronic filing, okay? So what's the first thing we have on there? Yeah, work uniforms. So let's put those work uniforms there. And he spent what, $75, right? Okay. All right. What else does he have?
Union dues.
Union dues. Okay. All right. And 328. Okay.
But the professional publications.
Yep. Guns or us? Body Armor Digest. I don't know. Okay. All right. And what if he had one coming that is monthly roses?
Nope,
Okay. I'm trying for him, Jim. Okay.
you're not gonna get it by us.
All right.
How about this 30-yard?
Tax prep, safe deposit box, we're gonna skip that. Gambling losses will come back. Legal fees for his divorce.
Oh, wait, you're saying for all, I was only doing what you do for the work.
Yeah, I'm kind of going through to see if we got anything, but we'll talk about that. Security guard training, required, unreimbursed. So I'm just gonna write training. And he had $400. Okay. All right, so we got that. Mileage for training. We're gonna come back to that because we're gonna do that a little different. Tolls for training, parking for training, and overnight lodging, okay? So let's go back to our 2106, page 1, okay? Yep. Okay. And enter your expenses. Remember it said the steps or whatever, okay? First thing we had there was miles for training. All right, yes or no? Yeah, it's in the thing. So where are we gonna put that?
Number 2.
22 or 29.
Okay,
Oh. Yeah, I would do it
nope, you're all right.
on- okay. I would do it on number 2.
Mileage,
No.
vehicle expenses.
You're doing the vehicle stuff?
Mm-hmm.
Well, it says it, or commuting to and from work.
But these are training.
They didn't know, well, where to do the training at work.
Okay, well, we're gonna put the training in there.
All right. So
Okay,
you want it in vehicle expenses?
yep, so we're gonna go to page 2 of the 2106, part 2. Okay. All right. And when did he put the car in service? And it gives you a little note there, doesn't it? March 25th of 2009. Why do you think they have to have that? What are they going to look at?
How he's been doing it.
Make sure that he's
Oh,
Always
that's
been
to make
mileage.
sure you do the same for a year and a year.
mm-hmm, yep. Total mileage driven, we really don't have. Let's put 12,000. Okay. All right. And what were the business miles on the trip? 260. Okay. All right. And commuting miles. What are we going to have for that?
$10. No. Yeah, $10.
Give or take. Okay. So, but basically, what is his mileage that he's getting for the 260? Yeah, we're not going to worry. We're just going to let it see how calculated other miles there. Took our 12,000 and subtracted the 260. Okay. And was the vehicle for personal use during off hours? We're going to say yes. Did his spouse have another vehicle? Well, he's divorced, so we're going to say no there. He has evidence to support, and it is written. Okay. So see, I answered those questions. And then what does it have on line 22?
139 bucks.
Yep. Yep, because that's 53.5 cents a mile times the 260. All right, so let's go back to our 2106 page 1, and what shows up on line 1?
$139.
Yeah, funny how that works, isn't it? Okay. All right, and we got a couple other things there. He had tolls, parking. So what, that is number 2. So I'm going to go into that square, and I'm going to hit F5. No scratch pen, just hit F5. Bring up my little calculator. 20 plus 10, which you could do this 30. You don't have to do the calculator, okay? That was an instructional moment. And then what about his overnight lodging while for training?
That'd be overnight 3.
Yep, line 3. How much? $280, right? Okay. All right, so we have that. Okay.
Ready to the chair.
Yep.
So, now the tax prep.
All right, so what's the next one you said, Marianne?
Tax prep.
Okay, so we're gonna go back to our, how are we doing, Jim? You get everything in there?
Yep, and that K was, yep, 2106.
Okay, all right. Back to Schedule A. We're gonna go down to that job expense and miscellaneous other deductions, lines 21 through 27. What's the first one? Tax prep. Okay, there's a line 22 for that. All right, $152, right? Okay. That's right. Okay, safety deposit box. If you look, other expenses.
That's safety deposit.
Yeah, okay. So if we go to that line that we could, the type, hit F9, and it's going to say miscellaneous deductions, Schedule A. So you're going to get a little thing that looks like that. You got that one?
Mm-hmm.
Okay. And put our safety deposit box in there. All right. And $50 for a safety deposit box. Okay. All right. What about these legal fees?
No can do.
No can do, right? Okay. Mary Ann was arguing hard for him, though. She's
Saving some money.
she's a very sympathetic soul for those that are being divorced, I guess. Okay.
Depends on which side.
Depends on which side. Okay. Now, last thing we have is from the bullet point, we had what?
Gambling.
Well, but what's the bullet point up there?
Oh,
Did he won
oh,
500?
he went to
Where's that go?
We're gonna take it off.
other income.
Yep, line 21 of the 1040 page 1. So we're going to go there and hit F9. Okay. And we're going to get a little worksheet for line 9, or excuse me, line 21. We do not have a W2G. So where are we going to put this in?
Unless
About 17.
Yep, line 17. Okay. All right, we're just going to put in gambling winnings, right? And how much did he win? 500. Okay. And what were his losses?
720 though. Why aren't we subtracting it off and then just call it even?
Because if he didn't itemize, he wouldn't get to take the losses. He'd have to put the income.
He gets to take the whole, he gets to take the extra part of the losses to itemize.
Nope. You can only take losses what?
So
Up to
where,
your win.
up to
Yes.
winning, that's what I'm saying. So why are we taking it off? He won 500. He lost
But we have to put it in his income.
Oh, you have to do it.
Yes.
You can't just see that. Just,
No,
Say, well, you're clear.
no, no, no. Yeah, you gotta put the winnings in. All right, now we're gonna go back to our schedule. You got that one in, Mary Ann?
Right.
Okay. And then after that, head back to your Schedule A. All right, and all the way at the bottom is our losses subject to 2%? Yes or no? Losses are not subject to 2%, correct?
Also not subject to-
Oh,
Okay, so remember where it says other miscellaneous deductions? The type, okay? So go in there,
You're on 28.
yes. All right, go in there, light up 28. Okay. See where it says other miscellaneous deductions? Yep. And I want you to hit F1 when you're in that.
That help?
Well, that's help, okay? And once you hit F1, I want you to scroll down, because this is about itemized deductions. And I want you to go almost to the end. You're going to see a little yellow triangle that talks about line 28. See that little thing right there? Okay. The yellow triangle says the expenses type can only be the following and must be spelled exactly as it appears in a case-sensitive manner. This is why, what are all those words typed in?
yeah.
This is one of the reasons that I have you do caps all the time. Okay? And what does it say?
Damage and losses.
Yes, these will be one of those things that if you do not type it in this way and you're looking for something that is not allowing you to e-file at the end of the day, you're going to be pulling your hair out going, what is wrong? And it'll say there's something wrong in the Schedule A, and it's going to take you to Schedule A, but it's not going to take you right to the line and tell you that you spelled something wrong. So I just want you to remember this part, okay? Make sure you do these, okay? Because otherwise you'll be sitting there for an hour trying to figure out why your return won't leave electronically. Okay? And how's it say? Gambling law says, okay? All right? You can't type in gambling loss. All right? Even though he was singular, I'm going to type in, whoops. Once I'm in there, hit F9, okay? And so go back to our line 29, or 20, yeah, 28. Other deductions, Schedule A, line 28. See the fifth choice there? All right, and hit that. And I'm going to type in gambling losses. Okay. Very specific. Gambling losses. All right. And how much was that?
720.
How much was that?
720.
How much was that?
No, we subtract the 500 off that?
How much can he take?
You take 500.
Yes. Remember that the
It doesn't calculate it.
doesn't calculate for us.
So you can't put 720 and then it just will wash it off anyway? Then? You have to put the 500 only?
Yep.
So you gotta figure it in.
Yep.
Ah,
All right. So that's where you got to know the law. Okay. All right. So we got that in there. Okay. All right. Okay. Anything else we have? I think we look pretty good, don't we? Okay.
I go back, I'll run the line from that.
All right.
Now, if we don't fill in the TS or J, will it not e-file then?
No, it'll be fine. It'll be fine.
But do you usually put that in? If it's a taxpayer, it doesn't really matter, you see. Or be the taxpayer.
Yeah, it's only this taxpayer. Like I said, you know, the TS and J is not required for anything on the filing. But if you have a joint return and there's a case that it seems like people are keeping separate money, or capital gains or things like that that you need to know if you had to go back and look at the term that how it's separated. Yes, taxpayer, spouse, and joint. Okay. All right. Sometimes when I do returns for something that has to do with an estate or something like that, I'll be very specific on the details, because that, you know, somebody passes on a return and it's married and spouse, and which accounts are joint, which accounts are just in one person's or the decedent's name.
Then you go back to it easier. Oh, it's a spouse.
Yeah,
Okay.
then you don't have to go,
Spouses.
then you don't have to do, sort through all the tax documents. Exactly.
It's more our benefit than the tax.
Or the preparer that may seize the return down the road.
Correct.
Yep. Yep. Okay. All right. Any other questions? I think that's it for his, right? Yep, that's all the information. So what'd you guys get?
242
Mhm.
and a negative 180.
Yep. Yep. Good. All right. Okay. So we have everything on that one. All right. All right. Any other questions?
The gambling loss, the extra just goes away. They don't carry over.
Nope. Nope. It just poof.
I just had a tough break. That's
Yeah.
Well, but in 18 though, he could maybe write off some extra though, if he had if his losses didn't meet his winnings, because what else could he take in 18? Maybe that was a trip to Vegas, or he did a bus trip to.
all. Oh, the flight,
Yeah. Yep. So.
the travel part.
All right. Okay.
That's what we get the first gambling problem.
I think so.
Between a security guard and a gambling problem, you know.
Two
So,
red flags.
yeah, 2 red flags on that one. Yep. Yep. That's definitely 2 red flags. Okay. All right. Any other questions on anything on that one?
Well, not on that one, but just again, for 18, a lot of this stuff is gone away. For
Basically, when we look at that Schedule A, and we look at, for him, line 21 through 27, okay? Well, no, 21 through 27 is a blank postcard because it doesn't exist,
Oh,
okay? Yep, so he's losing $808 of itemized deductions.
That's why it's gonna be really tough to
So-
deduct anything, because it's 24,000 if you're married.
Mhm.
But-
Gotta go over that.
but it may be the state we may be doing.
All that stuff that we just say that's going to be disappearing for 18, yes, there's a good chance it may show up on the states.
Make things more complicated.
So
Yep.
then you have to actually just go to the state return then only? I mean, it doesn't carry over from federal because you're not doing it then.
Well, but again, we don't know on the software right now how it's going to work. It may, because our software is really federal driven and the state return is driven by what comes off the federal.
Right.
We don't know if it's going to be staying that they're linked like that will do everything on the 1040 and then have it flow to the New York, or is it the case that the itemized deductions now are going to be separate?
Right,
We
so
don't
you
know.
wouldn't have that part, but the state would. So that could flow over, if it wanted to, it wouldn't be there.
You know, good possibility, yes.
Unless it does that red flag thing where then you have to go over to the state and
Mhm.
undo or do.
Yep. But does that mean
Finish
that,
it off.
but what I'm saying is that because the state was using the Schedule A for itemized, is it the case they're going to be unlinked now, or is the state going to know to only take certain sections of the itemized on the federal? So, but yeah, you're going to have to be a little bit more conscious of those, so. Okay. All right. Okay, any questions?
He was good.
Timothy was good. Okay? Yep. So, all right. So, that's that one. So for homework, let's see, we're going to do a quiz on 11. Okay. And we will be reading chapter 12, which is adjustments to income. Adjustments to income, it's almost like we're doing an extension of the itemized deduction, but a little bit different, okay? But we're going to do that, okay? All right. Okay. All right. Okay. And then we're going to do the remainder of the problems there. What is there? It was a couple more. What there was Glossick and Clemens. So 11.2 and 11.3. Okay. So we're going to have those, all right? Okay. Okay. All right. Okay. All right. And we're going to do a little interview here.